cover, which is a weekly recap, broader market outlook, top stocks to watch, top stocks and swings that we're going to watch, timing entries on 0 dates, and EMA trendline strat. We'll cover that definitely again because everybody needs to understand how this works. And just because you hear it once doesn't mean you own it. There's a lot of little moving parts on it. So Wyckoff basics, we'll cover that. And then obviously some mentality stuff. So let's get started here. I'll alert everybody. Please message in the chat if there's like something specific you want me to cover. You want your water? You go, Bubba. My sister was supposed to help me out with my son today while I did this, but she wasn't able to. So, all right, is what it is. Okay, so I'm gonna do the trend line strategy, and also because it may sound simple, but it's not, and it is highly effective, like really, really effective. So I touched on this Friday just briefly, and then I wanted to touch on it as we go over the weekly recap. All right, so let's go to the hourly here. And all right, so let's take a look at the 4 hour. Actually, it's a little easier. Okay, like obviously we had the news that came down, huge overextension, and it set a bottom, right, in the pre-market. I think that was Sunday night. Yep. And then they ate it up and they put us right in this balance of range. You can see there's just a lot of reactions in this area to the downside and to the upside. So in this zone right here, this is a dangerous zone to be long or short, right? We're touching the top of it right now, which, structurally you could say, yeah, it's not bearish, but we have broken the recent trend on the upswing. Right now, the question is do they bring it back up here and then dump it, or are they going to dump it, bring it up, test the zone, and then bring her down? That's really the main focus this week, is see what the data is going to say in the pre-market Sunday and in the after hours Sunday, and then in the pre-market on Monday. That's what I'm going to be watching. That's what Vince watches. Like, Jake, you got a good voice. Thank you. We all appreciate your singing voice. You want some more snacks? Here you go. Okay. You take some milk too. Okay. All right. So, the main point is we just want to see what data is going to show us. So let's talk about the trend line strategy. Last week they set a low. We didn't really know. Originally we had this trend. The trend line off here and then off here. So let's go back and do this. Originally like that. And if you zoom in on the 5, watch this. All right, so this was Monday, right? Or Monday to, what day was this? FOMC on Wednesday, pre-market. So what's interesting here is you had this trend line hit here, and then the low was set there. We set a trend line, and look at this. So that's a tap and go, right? You have a trend line there, and you're not playing this candle, but you're observing it, right? Because you're like, okay, well, they hold that trend line. And so I see a tweezer bottom here on the 5, a big buy, a bullish engulf, and you could take that long, and you'd be just risking the low of this candle right here, right? Or a break of the trend line. So you buy some time and you can play that. That'd be the tap and go. Then as they come back to that trend line, you're watching it very carefully. for a possible bounce again. But knowing that, you have on the 5 minute and also probably on the 15 minute, yeah, the EMAs have crossed over. So you can see that the EMAs are crossing over here, and its price is rejecting against these EMAs, and it's compressing into the trend line. Jace, we can't do that, Bubba. I'm sorry. Can't do that. Thank you. Thank you. So when you see that compression of the EMAs on the 5 and the 15 coming into a trend line, you do not take that long. You're looking to see this thing break down just like it did, and then have a retest that fails. It breaks down, and it could have been a fake breakdown because of this type of setup right here with this doji off support, but it didn't. It came back up, it retested the trend line here, and it failed. And then it came up again and it failed. So you could take risk off this trend line. Risking, you'd have to take risk to this candle right here. So that'd be 5 points of risk on SPX, and then you'd wait until you get the move and you'd sell. It's okay. All right. I'm going to take a 2 minute. He just fell. 2 minute time outside. Yeah. All right. Let's pray that he falls asleep. I just changed him and put him down for a nap. Whew. That was interesting. All right. So this is the failed retest. Okay. And these types of moves typically yield like massive returns because as price is shooting up in here, premiums are getting just crushed on the put side. And then usually you'll see a big impulse move down. In this situation, though, they didn't do it right away. They waited until, midday when the premiums were fully crushed and gave an impulse move down, wicked it up, stop hunted, and then drilled it down again. So you have the tap and go, you have a failed retest, and then you have a fake breakdown. We saw a lot of fake breakdowns last week. Shit. All right. He's gonna have to learn how to go to sleep here for a minute. All right. Here's a fake breakdown setup. Okay, you have that trend line. This is a bigger time trend line here. Let's go to the hourly. So you have a tap here, a tap, and a tap there. Okay, and then they fake break it down during FOMC. No, this is after FOMC, the day after. You can see how they drove it right underneath this algo trend line. So these trend lines are important because they fit in with Wyckoff. Like Wyckoff, as a Wyckofian, in strategy, they fit in. But you'll see fake breakdowns a lot. And, they drive it under the trend line, hold it, reclaim it, and then, another one here. So, when you see these types of moves, like the first thing you have to ask yourself is, where am I at in space relative to the trend line and the EMAs, right? So you can see here on the 15-minute, this is a fast move away from the EMAs, right, into support. So you really don't want to chase that at all. You want to see how it reacts around this trend line and give it some time. And you can see they're just fake breaking it down, and they ripped it hard and then dumped it again, fake break down, and then ripped it harder. So it's just something when you're watching these, you want to watch how it's reacting around the trend line. Are buyers stepping in or are sellers in control? And then also, what's the volume looking like, right? So it's pretty solid volume here. But then on this next candle, they ate all that sell volume up. You can see here, pretty solid sell volume. But then these next three candles, they bought more than they sold, right? So keeping an eye on the volume gives you an idea, and then also the candle structure and the extension away from the EMAs. Like the extension away from the EMAs tells you that you should never chase this. But if price shot up to this area and it started to reject and put in a doji or some wicks up here, and then the EMAs start to curl down like this into this resistance, then you take it. But because you have price, which is extended down away from the EMAs, and then they shot it back up. I mean, you just got to be really careful in this situation because obviously people are probably chasing this hard into the hole, and then this happens. So just definitely wanted to keep an eye on the price action, the candle structure, the volume, and then how far you are away from the 5 and 15-minute EMAs relative to structure, right? So that's one thing, how many people are buying calls down here, right? I mean, the risk to reward on calls is great there. Like this is a type of situation where we would probably look to buy calls right here. Why? Well, first of all, this is a big pivot. 27 was a big spot for us, right? And if you look to the left, you have all this wicks, all this demand here sitting there from the day before. And also, the biggest point is you have an extension away from the EMAs. It's a big extension. So psychologically, you have people chasing the hole, right? They're saying, oh my God, we're going to flush. And then here comes the M&Ms, the market makers, and they stop hunt everybody. And I guarantee you, when you watch the tape, you're seeing people, large, intelligent investors buy this zone here. Well, where's your risk? Think about it logically. What's your risk to reward buying calls here as opposed to buying puts here, right? Well, what's happening? Puts are juiced to the hilt here. Calls are crushed, and we have a massive level of support, right? So when you have a massive level of support and calls are, your risk to reward is great. Why? Because all you have to do is get as close to this support level as possible, buy some calls, and then wait for a 5-minute close underneath that support and then cut it. Because even if they break this support, they will come back up and retest it. And if it comes up and retests it and it's not strong, you cut it for break even or a 5% loss. It's the most intelligent way to day trade off of supports, off of trend lines, off of extensions. I've made my biggest trades off of buying extensions. So like as the market moves up into resistance here, I'm looking at puts to top them, tick them right there. And you might be thinking, well, that's fucking crazy because it could keep going like this, right? No, it's not crazy because on the 15-minute chart, when I get an extension into a heavy area of resistance like this, and I know it's a big pivot, I know that even if they do close this candle up above it on the 5, they still have to retest it. And then I can get out if I want. And even if they do that, I probably look to add even more size as they do that, because if the EMAs are here, price is here, and then they extend it up even more, well, the odds of it reverting back to the EMAs just increased at least 20 to 25% even more than here. So that doesn't mean, every extension get puts or every extension get calls. You have to understand where you're getting calls off of, defining your risk. Like for me here, if I'm feeling, really good about this and I got a lot more confluence than just an extension and resistance, maybe I have somebody loading 3,000 puts here, right? Maybe I have somebody loading 3,000 puts up there on a block, and then it's also there. And maybe I have bearish divergence setting up as well on the RSI. So now I've got 1, 2, 3, 4 layers of confluence and facts supporting my thesis into this trade that's a high quality A+ day trade. You're buying puts like underneath resistance, like this area right here. That's different than this area. You may be like, well, how is it different? Well, that's 6 points. So 6 points here, right? If this candle walks up like it did, like that, well, you're fucked. Like you're down a lot. Like, what are you going to try to scalp this for 6%? No, you're looking for a minimum on a day trade of 30% return, minimum, right? And so as we talk about, high quality trade setups and how to enter in on the premiums, that's what you're really focused on, is where is my biggest level of resistance? Okay. Am I extended out on the EMAs? Do I have bearish divergence or bullish divergence this way down here into support? And can I define my risk as tight as possible? If you can get into puts here and you top tick it with your risk would be this level's 88, and if you top tick it at 86, your risk is 3 points. That's amazing on SPX or SPY, and that's the goal. Because we're not always right, but when we catch that big move down like this, that's 400% minimum, right? That's the $85 to $500, right? So that's really what is really important. I want to drive home because I'm not going to be live Monday, Tuesday, or Wednesday this week, but I will be giving pre-market plans. I will be sending out alerts. I just can't be live. So let's go back to Friday. Okay. Unfortunately, I wasn't able to call this one. That's okay though, because there's always going to be a lot more like this. Okay. Now, we did this last Friday. The same thing happened last Friday, and we caught 900% on it. Yeah. So it shot up in the morning, made a high, came down, made another lower high. Well, that's a great area to get puts off of. What was interesting is in this area, they were loading puts. I alerted the 6100s up here, and they were at 5.7, and then I had to step away. I caught them at 6.0. But if you had held, they closed at like $6,500 a piece. So, yes, I did 100%. I wanted, so here's the hourly change. See this? This is the hourly change right here. And I said, as long as 50 or 6107 held, it's a long. That was what I said. Is verbatim. And it's in chat too. As long as 6107 on SPX, because that was my pivot, which it lines up with right here. Yeah, it lines up with this level I have at 6108 on US 500. As long as this level held, it's a long. Because what I was looking at was we were in a UTAD formation on the hourly, right? And you can't tell. The thing is with UTADs is you can't tell when they stop until you get a lower high, a second lower high M formation confirmed. So that's why I said I like a long here, right here, because this could have gone like this, like that, to a new high. And then this trend would have been still intact, but it didn't, right? I said long here, right? Stop loss is obviously as tight as possible, right? And then when this is the key point here for you, Sultan. If this candle, this trend cannot clear that point, this high, you never take it long again the rest of the day. Never, right? Then what you do is you use that pivot I told you about, because the last thing you want to do is be in this situation. Right? You don't want to be in that situation all day. So what you do is this. Is I said as long as 5607 or sorry 6107 is your pivot, you take the pivot and you utilize it as leverage to define your risk. Does that make sense? So it doesn't matter up or down or sideways. You need to use the pivot as with a neutral mindset, because that pivot is I had gamma sitting there. I had a huge structure sitting there. It was a big pivot that we had to break to see. If you look over to the left here, this spot right here, if you look on the smaller time frames, look at how they held it up here. Break down, hold. And then this level was retested, tapped. Okay, tap. Okay, so this was a big spot for me. If I go down to the 5-minute, but you could even see even closer confluence. Yeah, so like for me, so like look at this wick. So this is the trade from last Friday. We caught identical setup. I don't know. Do you guys remember this from last Friday? The high got set in. Then I said down here, I said, I'm not interested in calls, but I would be interested in getting puts right here. We entered puts right there. We top ticked them. You can even look at the timestamp in the pro trade zone last Friday at this time. They're 0.85, 0.90, and we sold them for 200 right here, right? Because we had a trend line. And then they held it, bounced it, and then I re-entered right here. Not right here, but right here on the close below, right? At 1.79, and I closed them down here at 1100. So, but it's the same principles. And the reason why I chose that level as such a big pivot is because when this happened, this big reaction, look what happened here. Look at these wicks and how you have once this thing broke, this big wick tried to come back up and get above it. It rejected. This candle almost pretty much closed on it. right? So that candle closed right at 857 or 6108. These candles over here are tapping it literally and closing right on it. So it's a clear gamma and structural flip. So that's why I label it as an intraday pivot. Okay, that's really important. One of my best skills is identifying huge pivots. I don't identify pivots just based on price. I label them based on huge reactions in the market and gamma. So I don't just be like, oh yeah, this is structurally a good spot. You know what I mean? There's a lot more thought that goes into it. So the same thing happens, right? That pivot that we talked about, look, they came up, support. Now support. Now resistance. Oh, reclaimed. Now support. Okay. And as soon as this candle happens, right there, that's the cue for you 100% go short. But you don't chase this short in the hole. You wait. And what are you waiting for? Confirmation that this price cannot reclaim this level. So once it shoots down here and this candle right here closes, your mentality right here, this candle, this doji or spinning top, whatever you want to call it, once that closes, you go fucking short instantly. Why? Why? Because it closes below 6100 and my 50 or 6098 pivot, right? So as you see my pivots and my levels, right, on the cells things, you like, okay, mark them, right? And then you put on your charts and you say, oh shit, they closed below it. I'm gonna get in as soon as I can, right here or right here, because now my risk is defined as 6100, right? It's not here. Now it's my risk is right there. You see that? Everybody throw a one in the chat if you picking this up, because this is important to reading price action and understanding, hey, I don't want to get calls here, you guys. I don't want to be getting fucking calls. Okay? You need to, but here on a reclaim, you can get calls. And that's okay. It's not a bad trade, right? Because it reclaimed, it held, it's support, support, support. And your stop loss should be on the contract chart under this level. Okay? I can't go to that actual contract chart, but what I will do is they're expired. So let me go to 1 DTE. We'll do $6,100 calls. Chart. And then I'm going to double up here. Just give me a second here. I'm going to whip this up really quick. Option, then we'll do $6,100. Put. No, we'll go 60/50 put. Yeah, that's more realistic. Okay. 5-minute chart. What time was that? 10:20. All right, I'm going to cut not cut, resituate my screen so you can see what I'm looking at. We're going to talk about contract charts now. And I'm going to tie it all in together, okay? Okay, so so on the left here is the $6,100 call for Monday. I can't sit there and do Friday, unfortunately, because I don't have the contract charts because they're expired, but we'll use this. The same thing applies. Okay, so in the morning, as the market's shooting up or going down or whatever, let me get my 5-minute here, 5-minute there. Okay, what are we going to do? And this now we're going to start covering, uh, you know, entries, timing entries, and tie it into extensions, structure, finding your entries, right? So now we're going to, one second. Now we're going to tie all this together. So you can see here that breakdown, actually the call would be at 9:20. So 9:20 on my chart. So I'm Eastern Standard Time. Maybe, hold on a second here. What was the top? Top was 8. Actually, Jesus, all right, whatever. That's fine. 8:10, 8:15. So this chart that I'm showing you is Eastern Standard Time. Okay. So as you have your chart here, let me pull this up here. Draw trend lines. Okay. So you have the chart here, and you're like, okay, I have support here, right? There's support there, clearly. Now, if these are zeros, that's fine too. Okay, then you're like, okay, well, where's my other level of support? All right, it's right there. Okay, so at this time, this was the top. Then it came down, these contract charts, a reclaimed right here and held. So even on the contract charts, if you enter off this support, then you can see it's support. Tap, tap, right? This is support here. Okay, tap was resistance, came down, nice hammer. And say you buy calls. Obviously, these are expensive because we're using a different date. But for example, if you buy calls here, and it doesn't break this level, 29, and it starts to come back down, you can stop out. And what you would do is you'd put your stop. Say, for example, you see the hammer and you enter right here, a 23.63 off the support on the contract charts. And that matches up with a level which is 6,108, right? Or 6,107 on SPX. So, okay, hold on. Let me answer your question. Do you really think levels matter when Trump hit a news hit and drove a ton of volume? Yeah, I absolutely do. I'll show you why. Okay, let me switch the stream over. Hang on. Actually, you know what? I'm going to show you something that you won't. You'll see here. Okay, look at my left chart or my right chart. This is the 60-50 puts just for Monday, right? Okay. So what do you see right there on that candle? Somebody bought 800 volume at the low. Okay. Somebody also bought 400 here. And these are like $400 a contract. So it's not like they're putting tiny bit of money in here. Somebody bought 500. So there's like 1,300 on volume right here, right? They bought here, right here at 400. They bought there. They bought another 500. They bought another 500, right? And they're still buying. These contracts are off of this support. And as soon as it breaks down, this is this. Hold on here. Where's it at? 31, 12. Yeah, but it's not rocket science. That's what I'm saying. Like, all right. So let me show you now the structure, okay, and why levels are important. I get where you're coming from, but I'm going to show you why it's not, or why levels are key. Because it's not people selling. It's algos. It's computers. The computers are selling. It's not you, me, or Tommy, right? It could be some retail, absolutely, for sure. It's all mixed in there. But nobody moves the fucking market 100 or 80 points down. No one. It's computers. Okay? And if you want to argue that, we can argue it. I'd be happy to. And I'm going to show you why it's computers. Watch. So let me ask you this. Why do you think, well, I'm just, yeah, but you're asking, do you really think levels matter when Trump news hit? They do. Absolutely, they do. 100%. Because watch this. It's no different than when you get a CPI print, right? Say, for example, CPI data comes out and there's just a shot up, like boom, and then all of a sudden it just rejects at a specific level. And then it comes down and shoots right down and then fucking bounces. There's a reason why those computers are stopping right there, right? So now let's take a look at these levels that I have. Okay, so news hits, it shoots down, right? And where did it close? 95. So now the news hit, right, up here, right there. News hits here, okay? It shoots it down, and what does it do? Well, this one, this candle right here, wicks. Where did it wick? 61, 6102. But what's interesting is these wicks right here are in the same one, same spot, same fucking spot. That's not like that's not a coincidence. It's not like, oh man, no. That's not a coincidence. That's short covering, and or not short covering. It's the algos like driving it back up to stop hunt people, and then getting people to shake long or screwing people that are chasing, right? And then look at this. Then where does it close? This candle right here. Where's this candle close on the 5? Right on my pivot. Weird. 88. Where's this candle wick up to? 88.89. So this zone right here, I mean, that's news, right? It's news. And it just wicked off. So I trade wicks too, right? So I think like as the market starts to drill, regardless of news, the next point as it comes up to retest would be here, right there. And if it breaks that, then it's here. And it's this supply area, right? So that's structure. So these algos are reacting to news in these computers, but they're reacting exactly the way they should, exactly the way I would expect them to. I'm not going to be panicking. I'm just going to be playing off the level. Like, why wouldn't I? Right? It's not chaotic. I think maybe that's what you're asking is like, just because there's news, it's not a chaotic sell. And even if you get this, so there's such a thing called, it's called a BlackRock algo. They have an algorithm where it literally fucking dumps the market. Like it could be 150 point sell in a day, right? I've seen it. I actually know it's there. And when everything gets a little too heavy on one side, they fucking rinse people, right? So coming back to this levels, you can see I have an orange line right fucking there. This orange line is a fib. And this fib is within a point of my other GEX pivot at 6088. You see this pivot right here? Look at this. Well, price action was slow over here. Tap, tap, right on it. Then what happened? We have speed. We have fucking news. It closed right. The candle closed right on my a point off of my pivot, and it closed right on my fib. This one drives right. Like that's just crazy. It drove right to the fucking trend line, dude. Look at this. Look at that. Look at that wick. You got fucking crazy news, and look at this wick right there. It's touching the trend line, touching it. That happens more often. You could say, yeah, it's coincidence, but no. It happens more often than you would believe. So, yeah, news, but still going to react to levels no matter what the news is, no matter what the news is. Look at this perfect example. Let's go back to all I'm saying. Yeah, whatever makes you make money, buddy. If you don't think trend lines work, that's fine. I don't care. I can give you fucking 1,000 facts based on trend lines and how they actually do work great. I'll actually throw it right now. Let's talk about trend lines and structure. Do you think Wyckoff works? Or is that discretionary too? Oh. Do you think Wyckoff is discretionary? I think everything works some of the time. Okay. So this is structure. This is why trend lines are important to me. Algos buy off these trend lines, right? Because it's a trend, right? And then also, what else do you have within a trend line? You have triangles that form, okay? Rising wedge forms. Falling wedge, downtrend. The downtrend breaks, retest it, and then goes, right? Uptrend holds, and you buy it. Tap and go, tap and go, tap and go. Bull flag structure is built within trend lines. So trend lines to me, whether you think they're discretionary or not, to me, I think they are important because it allows you to define your risk. Because if you can't define your risk, how are you defining it? How do you define your risk in a trade? You just grab in. I just question that if I find a repeatable process to employ over. Yep. Well, I've been trading for 14 years and pretty consistent. So you'll see though, the more you see it, it sounds simple, but a lot of people don't care about simple. They like to follow flow and blindly follow it. So yeah, you know what? That's why, there's literally only three ways to play a trend line. It's literally that simple. And it's tap and go, very basic, fake breakdown. Reading the fake breakdown understands how to read structure, volume. At the end of the day, if you, if you want to, you know, uh, SMT, trend lines, EMAs, it doesn't really matter. The only thing really fucking matters is if you get paid consistently and if you can define your risk. So I really don't care what anybody does as long as they get paid. My job is to uh, consistently pay out. And in the last 25 trades, if you go look in the swings, obviously we stopped out of a bunch because of the risk. We stopped out of our newly added swings right here on this break, right? So, but if you look at the last 25 swings, I'm running almost 90%. So, but trend lines don't work though. Because on my swings, I use trend lines to understand compression. Like trend lines build out compression. I'm going to go and show you what I'm talking about. Now let's talk about the EMA strategy with trend lines. All right, so where is it at here? I'm going to use it in multiple areas. Okay, so hourly, November, where was this at? EMAs, give me my EMAs here. So my swing strategy is an EMA and trend line combined strategy, right? And it also fits with gamma too. So I don't look for one thing. I'm looking for multiple layers of confluence before I take a trade. Here's my trend line right here. And here's my top trend line right there. Boom. There we go. All right, now, okay, here's these trend lines. Yeah, I don't try to guess. I do not guess. If I guess and I'm wrong, I stop out. I don't care. And everybody in here knows I have no problem stopping out. I think it's the stupidest thing ever that people are like, oh, you stopped out. Who cares? Fucking save money. Define risk. You're wrong. You're wrong. You know what? And then if I lose less and win more, doesn't that make me a great trader? Yeah, I think so. All right. So here's a classic reversion setup. We talked about this last Sunday. Um, uh, you know that you use them exclusively in work makes. Oh, trend lines. Yeah, I don't use anything exclusively. Um, all right. Yeah, and there's a lot of stuff that I even use that I don't even talk about, and I might soon. So we'll see. But as EMAs are in a downtrend, you're not obviously buying calls, right? What's happening? Negative gamma is increasing, puts her in control. And then all of a sudden, boom, buyer step in, a massive candle bounce from 213, 214, all the way up to 217. Now that candle is communicating to the put holders and to the sellers, hey, buyers are present. Would you agree with that? Yeah, I would. Makes pretty logical sense. But also from a statistic standpoint, you have an EMA right here, and you have a massive extension on the hourly away from the EMAs. Huge. Statistically, probably the probability of it snapping back is very high. So now it shoots down. It sets a bottom. Okay. Now let's talk about Wyckoff. Tie it all in. Why not? What the fuck? Let's tie it all in. All right. There you go. There's your bottom. Okay. And then this is SC called selling climax. And then this would be called AR, right? So now you draw your top of your box right there. And this is called a trading range. The trading range is now defined, right? So what's happening within this trading range, right? It's called accumulation on a smaller time frame. So let's pull up our Wyckoff chart. Okay. There we go. There's our Wyckoff chart. Nope, this is the wrong one. This is a spring. This did not spring. It did an A2, which is no spring. Classic accumulation by the operators or hedge funds running the market, or banks, whoever you want to think runs the market, because it's not retail. It's not at all. Okay, so you can clearly see this would be SC. Why is it SC? Because you have selling climax into support. It defines the range, right? Then it shoots up aggressively, defines the range. What's what it did? Bomb, boom, defines the range. Then it comes down, ST right there, shoots up, gives us a B1. It doesn't have to break range here. It doesn't have to break range. It just has to, the volume and the candles have to act accordingly within a specific range to identify that it is accumulation, right? As you can see here in the schematic, after this BST is set, it starts to rise up. And what's happening on the EMAs, okay? Let me get out of this. There. What's happening now on the EMAs? They're flattening. They've completely flattened. Okay. I've been doing this strategy for 7 years now, and it's fucking gold. Like, obviously it is. It produces 90% winners over 20% trades on average. It's fucking ridiculous. So we talked about this Sunday, last Sunday about, and I said, you can go to the YouTube channel for members and look at the YouTube channel and listen to it. And I literally said down here, Uh, oh no, this is the wrong one. This is September, but the same shit happened literally this week. I'll show you. So down here, I was like, you guys, this is going to drill the 200, then it's going to flag, and then it's going to fucking rip. That's what happened. That's why we got the 240 calls for September or for February, and they went 400, 500%. And then we had the May calls, the 250 or the 250 calls for May. We had the 240 calls for February at 2.6, and we had the and those went in the money. And then we in a week, and then we had the 250 calls for May at $385 a piece. I mean, just fucking banger trades from this type of a strategy. So you don't buy calls here. Okay. What you're looking for within this strategy is to define your box, your range, your trading range here, here, and then you're seeing where it's rejecting on the hourly. The rejection here, rejection here. As soon as this wick rejects, now you draw your trend line on the top. As soon as this wick comes down and defines it, you draw that trend line. But first, what you're doing is you're taking this trend line, and you're probably up here, and then you lower it down because this was the maximum down range. Then you know that that's BST, right? Then what you can do is buy the bottom of the zone right here off this candle structure right here. You know that they're driving wicks off the zone. So buy calls longer dated because you know you're going to get the move to the 200, right? And if you don't, your risk is clearly defined by a trend line right here. If it breaks this trend line and the retest does not reclaim, then you get the fuck out. Or what you could do is define it by this wick here because you know this was the selling climax and the most amount of buying pressure came in off that level. You could set your stop here with time. Add one scale here. If it comes here, great. If it comes down here, add, cut it if it breaks this level. But if it does and it starts to stair step out, start loading for the pressure up. Because what happens when you get pressure up? It's like a tube of toothpaste. You have your structure within the trend line, right? Price actions compressing within it, tighter, tighter. EMAs are starting to curl, and you get a boom explosion. Well, what? Why did that explosion happen? Well, this whole time you're in this box in this trading range and compressing tighter and tighter within the trend line. Sellers are selling their puts and buyers are buying calls. So gamma is shifting from negative gamma to positive gamma. That's what's actually happening. And that drives price up because then buyers start to come in and press it. Then you get the shift in the deltas and the IV changes and the stock explodes. Very, very simple strategy. Okay, now let's go to, so you guys don't think I'm full of shit, right? Let's go to this week. Oh shoot, hold on. There we go. Now let's go to this week. There, get rid of that. Okay, you have a selling climax right here. There's your selling climax. There's that. And where's your top of your box? It'd be like hourly right there. This is a little different setup. So this is cool. You can see this. Okay, so this is an A1, accumulation 1. Check the 4-hour quick on this setup. Yeah, there we go. All right, go back to the hourly. Okay, here we go. It's based on Wyckoff. So I'll show you. It takes a little time, but to understand it. So if you're looking at structure, okay. So I love the questions. Thank you for asking questions. I love engagement. It's really important to be able to learn. All right. So how do we identify this trading range? The trading range is here, here, right? And not so much here, but this is kind of your top, right? Your top of the trading range. This schematic is a little wonky, meaning it's a little harder to identify. So what you're looking at is a selling climax on the first move down. Here's your PSY right there, and it's way up here, right? That's PSY or PS. It's called preliminary supply. Okay, after this move, it comes flushing down and it hits a bottom. Now that's your SC. So you have to label that first move as the bottom of your range, right? Then it shoots up, comes down, shoots up. Now this would be the top of the range. This would be AR, right? Because the range is so wide that this would have to be AR right here. So then this is the top of your range, right? But they come down. This would be ST right here. So ST is right here. So it comes down. It's called secondary test. So it shoots down, selling climax. You define your bottom of the range. Then it shoots up right here really fast. And that's your top of the range. Then it comes down. It does, it's called a secondary test and stair steps up. Okay, now you have, this is called B1, phase B1, right? Then it goes to BST. But at what point? Yeah, you're waiting. You're not trading this movement. It's not. I mean, you could, but I wouldn't. I would never trade this. You identify. Okay, Apple's selling. Let's see where it wants to bottom. I know the 200 sitting around here. It could bottom out. Let's let this price action develop. Like for me, if I'm going to load a swing on the hourly, ready for a move like this, I'm not fucking with this. I'm waiting for this, right? And so I'm waiting to see this price action, this garbage chop on the hourly to define my range. I'm not in a rush, right? So like if you're like, that's the part of swings, right? You want to make sure your entries are high quality and that you like, nobody wants to be in a fucking swing that takes 3 days to fucking move, 5 days to move. I don't. I'm trying to get this swing to move $7, $8 in a day or two, like, or less, like, or the same day. Like, I want that's my whole strategy is identifying swings that move 5 to 10 or more dollars within 2 days, right? With a month's time on my contracts. Then that's what I do. If you go look at all the trades, all the swing trades, they're all fucking exploded within a few days. So, or the day of. So here you have SC, okay, and this is BST right here, BST, and this is the spring right here. That's the spring, the shakeout. Break below the range and wick below. That's this guy right here, right? So this was Monday. Yeah, Monday. And this is when we got in, right down there on the spring on February calls. And look what happened. Weird. It went exactly to where I said it would. On Sunday. Sunday, on that YouTube video, you can see, I said, this price action is an A plus setup. This thing's going to rip right to, I think I had my trend line like this. Yeah, like that. Right? And this was something like this. I don't even know what I had my action at on the price action. I just know that the top was up here and that the bottom of the range was here, and we knew this thing was going to rip. So we bought off the lows of this break on the upper part of the range. Quick reclaim, held, we got in, and then the next day or that, I think it was that day actually. Yeah, that day it ripped and broke out the whole day. I remember that thing because I wasn't paying attention to it. I'm like, and guys are like, oh my God, the swing's fucking ripping. So anyways, the top of the range is here. Obviously, how do you know? Because you have SC, there's the bottom. Here's a fast move to the top. Yeah, 1, 2, 3, 4 hours. Yeah, I get that. Sometimes it's not perfect, but it's still the top of the range. You know, it's pretty clear that that's the top of the range. Now they break this range, right? But then they false breakout, bring it down to the bottom of the range. So you know that this is the range, right there to right there. Then B2, it can go up here, right? It's not like it can't do that, and it does. It shoots up high. It's a huge stop hunt, right? Getting puts out, getting people to chase, right? Comes back in, shoots up, comes down, and then does a massive spring, huge spring. This is a crazy chart. You don't typically see this range like this, but it does stair step. You can see here, there, and through. So here it does the same thing. Up, down, lower high, comes down, and then gaps down into a spring and shoots up. Now, look at this. After it broke the range, you should already be in on this break right here, right there at 222.5. Easy, because then your stop would be under 222, or it could be under that wick or under this support. You know, $2 risk is not bad. But if you're waiting to get in up here, I mean, we're selling to you. Our contracts are already up 300% at this point. We're selling to those kind of people. And that's fine. You make 100% on this move. Congrats. We're selling our runners at 500% up here. Why are we selling them? Well, any idea why we would sell our contracts up there, our runners? EMA extension. Hourly's here at 236. They extend it out to 240. It's a $4 move away from the hourly. Why would you hold your contracts in that when you know statistically 95% of the time it reverts back? If you go back and look at all the moves away from the 13 and 21 on the hourly, you can see it. It happens every time. EMA extension reversion, extension reversion, extension reversion, extension reversion, extension reversion. I can go on and on. You will never see price just go like this. And the EMA is like way up here. Like you just won't. Maybe for a COVID type black swan scenario, yeah, but not typical stuff. Even look at you had Trump news, right? Look at this hourly. Let's look at 15 minutes. Okay. Look at this. Like they're still driving it up, stop hunting, driving it up, driving it up. So when you get a sell-off, you know, to be able to define your risk, you just click on the 5. Click on the 5. Say, I'm going to try to get an entry off this trend line right here. What or off the 13 EMA. It's easy. It's so easy. And then you take a trend line and you draw it. We did this right there. You see, there's your downtrend. After this broke, this level, there's your downtrend. We took puts off this. We took puts right there, and they went 330%. EMA confluence plus downtrend and structural off 70. So, any questions about that? It's kind of a lot to unpack, but that's, I mean, the EMA strategy is fucking gold, you know? All right. How do you know it's a stop hunt versus a reversal on Fridays? So you know it's a stop hunt because, oops, hold on a second. Pull it up. All right, so to me, this is how I identify stop huns. Pull it up. All right, I know this is a huge level, right? And when we are in a downtrend, I know that stop hunts come, but whenever the stop hunts come, they have big rejections, right? So what happened here? Big extension down, it shoots up right to a level 85. This is right here. This is 6085, right? So 6085 is a big gamma level, right? It's also the PPI high area, right? For December, that print, the data print high, right? So I know that's a big level. And I know that we get reversions, right, in a downtrend. But how do you know that it's not a reversal, right? Well, you look at the volume. Sell volumes increasing, buy volumes decreasing all the way through this structure. It's 50-50. Plus, it's reacting negatively to this 85 level, right? So you're not just saying, oh, well, this is a stop hunt, or oh, this is just a reversal. You have to use like common sense and logic in the moment, right? So you know that this is a level, 85. Where's that here? Right? So that's a level. And this is another level at 70. Gamma level, 60, 70, and also a nice, it's structural level too. If you look to the left, it's been a huge spot, right? A huge wick right off of that level. That's a big deal. It's resistance, resistance, okay? Wick right off of it, resistance. All these levels have reacted huge to 60, 70. We know that, right? So for me, when I'm in this trade, let's say I get puts up here, say I get puts here, or even here, fuck, right there, doesn't matter. And I buy, 1, 2 strikes out of the money up here, and I'm fucking printing, and I'm like, I think this is gonna, and I trim here, right? And I got my runners. Well, what am I thinking in my head? I'm thinking, okay, where's my stop out, right? Where do I stop out? Okay, well, you know that 70 is a huge level. So as it comes up into 70, you're watching two things: volume and velocity. Is this move aggressive? Is volume increasing? Yeah, you could say it is a little bit. Well, this one wasn't. So within this trend, it's like, okay, big buy, big sell, buy, buy, buy. So now there's good buy volume. But what's the thing? They're in a big structure. Now, does that buy volume continue? Well, it doesn't matter, right? Because if you have your risk defined at 70 and you're in up here at 80 and you've already taken profits on an extension down that was 300% and you have 3 runners out of 10, your stop out should be a 5-minute close above this level, right? If the candle can structurally change momentum and the buyers can change momentum and get this thing up, stair stepping and holding above the 70 level, then you stop out of the runners, because your stop really should be at break even. Obviously, you have theta on 0 DTE, but if you set your stop at a 5-minute close above this level at 70, you never stop out, right? And it's basic, thought process in the moment. But the problem is a lot of people get freaked out. They see their money and then they see the money go down from 300% to only up 70% here. And then it's like, well, what do I do now? Oh my God, I stop out. And then they see it rejected and then they get frustrated and, talk down to themselves or whatever it may be. And that happens, right? So then on this move down here, they just slice through support and you sell another 1 or 2 contracts and then let the rest go with your stops above break even. Does that make sense? Now, if you know this is how do you identify it as a reversal? Well, this buy volume here has to continue, and the structure of the contract, or the structure has to keep stair stepping up and get above the EMAs and above this level of support to change the momentum from down to up, right? That's how you do it. And that's how you time entries too. So, looking at, these contract charts and stuff. Could I look at Thursday close? Yeah. The last 2 days, I was unable to catch those big, huge moves because I was filling out paperwork. I had other stuff I had to get done. And then Friday, I was putting my son down literally for a nap when the fucking news dropped. Like, literally. Just like putting him down for it was ridiculous. I was a little bummed about it. Okay, so here's Money Time's question. Okay. So this is the 5-minute chart. What do you notice different between this 5-minute chart and the last one? You have this one right here, and then you have this one over here. What's the difference? You see any difference between that and this? A huge difference. Yeah, exactly. Not only that, but it got moved away really far, really fast, right? So you got to think of it like this. In this moment, in this moment right here, and then especially right here, the odds of a fast reversal off of support, which is 42, this is the December CPI zone, the low and the high were printed here. And I've been telling you, everybody, 60.42 is a big, big spot. Look at that, right to it, 60.40, closed here at 60.42 on this one. This candle right here, it closed on the exact number to the penny that the December CPI low print hit. So here was another example for you, Salt in the Swing. Here was a news candle, and this candle closed on a data print level to the penny. And a zone. This 40 zone has been huge, huge structure. So, and then to your point, Money Time, it's like, yeah, okay, you ideally really, really should have been looking at puts here, because here you're in a big spot. 88 was a big pivot. I said it in the pre-market thing. And what do? They rejected 87, which is a fib, close enough, if whatever you want to call it, close enough for government work, but within a point of it, and they weren't able to close above it. And you have a tweezer on the top, and you have an extension into resistance, and then all of a sudden news came in, like coincidentally, right? And then you get the stop hunt. So, like, yeah, a little different situation, because the EMAs on Friday, it was big sell, right? And then a wick, and then sell, and then wick, sell. And the whole time the EMAs are just gliding down. And whoops, as you have the EMAs gliding down, you have price action pushing up, rejecting, right? So it's a little different structure. Plus, at this time of day, you literally had 15 minutes left, 20 minutes left in the market, right? So if you look at this time of day, this came 40. No, this came at a couple hours. 2.5 hours, couple hours before, right? Couple hours before the market closed. That's a big deal. That's a huge difference. And here they go. They just stop, wick, walk it right down. This is typical structure when you're selling, right? Here's the UTAD on the 15. This is a UTAD, A plus UTAD setup. This is a UTAD. This is the UTAD playing out. 1, 2, there's the M. Flush. Actually, whoops, my bad. It goes like this. It goes up, down, up, down. They should have made them low, but it doesn't really matter. They could have, you call this the top right there, and then down. Yeah, that's probably what it more would look like. But regardless, you have an M. When you get the M and it breaks that low, it's flush time because here's your M, 1, 2, and then little baby pop, and then dump. And then as it's flushing, you have a break within the range, pop up, M, and then flush. So break within the range, pop up, boom, flush. So they played this whole move out. You can see it clearly. Let me see. Here's like this. Scroll that down. Grab this. Pull it over. You guys can see this. All right. All right. So here's the UTAB playing out. Shoots up. Comes down. Shoots up. Comes down. Up. It could be up, down, up, down. It drills, shoots up, comes down, up, drills again, big bump, comes down, and now it's just consolidating here, right? And that's exactly what this did. Algos sell like this. Algos perform like this. This is why we do this, is because the algos move like this, right? It's just like the way they do it. Okay, look at this. This is an earnings play I listed into the in the chat. I like puts on earnings. Why would I like puts here? Okay, well, this is a fucking perfect UTAD setup. Shoots up. Yeah. This is a perfect UTAD. The all-time high drops down, breaks it. UTAD 1, 2, 3 into earnings, new high, and flush, and plus flow supported it too. It was pretty crazy. All right, now I want to talk about. So we covered the EMA strategy. We talked about this trendline strategy. We talked about Wyckoff basics, broader market outlook. Let's talk about that quick. So China should get a little more pressure. China should see a little bit more pressure. Why? Because the dollar is popping. This is the dollar. I thought it was going to go a little lower, but it's like this now. Okay, so I would like to see the dollar pop up and reject right here. I'm going to set an alert at 108.80. Because why would I care about this? Well, It did float. I'll show you. I posted it. Uh, yeah, that's what it showed me. That's pretty crazy. Look at that. That was day of. You see, let me know when you see it. You fucking nuts. So what they did was they bought the 220 puts, and these are floor trades, right? So they had 400,000, 400K on the 220 puts and a block. Then they had another 350 on the 220s. So they had close to a million or 800K on the 220 weekly puts. Then they grabbed out of the money 202.5 puts for 250K. So they have a little over a milli on puts, and they hedged it with the 235 calls for 250K. It's a basic just 2-to-1 hedge, right? Or no, not a 2-to-1 hedge, like so like obviously they lost 270K, but they probably made like 9 million on that trade. So it doesn't matter. So China should see some pressure because of the dollar popping. Another reason why I just sliced our runners and swings on China. We fucking crushed China. It was great. Now it's time to sit back and be patient. I want to see this dollar pop Monday or Tuesday into this level. And then I want to see it. I want to take China off that. China should see weakness on this. So if the dollar rejects this 909, let's call it level, I want to buy weakness on China because I think the next move is going to fucking drill. Not down this far. Let me remap this. Not going down that far. There. Then it pops up to here. Then it drills to there. Then up, down, up. There. That's more structurally aligned. If I take trend or take levels and I just throw them down, watch this. That's a level for sure. Okay, that's a level. Right there. Right there. Spot. And then this is definitely a level. And then we'll go down here. And then we'll go right to there. We have another level right there, 104 and change. So I would like how I trade China is a little different than most, but it's exactly the way I have a friend, I have a couple of friends in the hedge fund world. I have a buddy who does the buying and selling for one of the largest hedge funds in the country, and then I have another friend who's the director of Morgan Stanley in Southern California at one of the branches, and one of my friends has told me, he said, trade China off the dollar. It's the fucking easiest way to make money. And it's true. It fucking works great. So looking at the schematic on the dollar, if we can see resistance right up in here at the 109 level, we're going to see weakness on China, and it's going to be kind of like a shakeout. And then on this move down, China should fucking rip, right? And so that's what I'm looking at on China. I think that's a sneaky trade. I think people are going to get shaken out, and we're going to buy that weakness. Let's take a quick peek over at China. Look at this. BABA starting to show an SOS to BULPS, a bull flag pattern above the range. This is our range right here. It broke it, and now it's going to bull flag. And what's weird about this is it's actually bull flagging back above a trend line support. So this is a big support back here. Had a fake breakdown here, held, shot up, came down, returned it into resistance, like to a T, shot up, came down, wicked right off it, shot down. Bob was a really hard chart to chart, or really hard stock to chart, but it works pretty well. We do fine. So now I'm looking at this. Where is my range going to be defined on this BABA chart? It will be hourly. Okay. Now this is another setup where I'm going to do, you remember how you guys, I just went over the hourly swing trade breakout setup? Same shit applies here, guys. Literally the same stuff. So we have a breakout, which, what did we do? We timed this. We got in our BABA swings and our China shit swings when nobody wanted to get in. We got them down here, 84, 85 bucks. And we were already in down here at 82 on some of them, right? And then we just really sized in here because we knew this was going to break. And all we had to do was define our risk off 85 and it just fucking ran, right? Beautiful trade. Really nice setup. Fucking perfect. So now we have another support that's holding here at 96 or 97, 40 something, 40 and change right here. They closed the hourly on it. So I'm watching this lower trend line here within this bull flag. Or bull pennant, whatever you want to call it. And as long as this structure holds, I would like to see this happen this week. Coil up on the weakness and fucking rip through the zone as the dollar does the same exact thing but opposite, right? It starts to, this is the hourly. So as the dollar is going to go like this, it's going to shoot up, come down, and this will be consolidating in this zone of the dollar. It'll be doing this consolidation. Once this drop comes, the BABA will shoot up hard. It should shoot up out to the top of the range, and then it should wick down, retest this range here or even here if we go above it. And that retest is going to be a massive fucking move in China, and it should fucking rip face. Okay? So this is going to be a top setup. We're going to be watching Baidu's similar setup, really nice. And if you look at the weekly charts on these, they all look great. You know, we covered this last week or a week and a half ago, 2 weeks ago or more. The tweezer bottoms. When you see tweezer bottoms like this on the weeklies, you know, Baba had a beautiful tweezer, really nice tweezer bottom off support right there. Not a perfect tweezer, but close enough. It's above a 50% retrace close. You have PDD. This one's really kind of been a thorn in my ass, to be honest with you. But it's still bullish engulfing off of a huge wedge on the weekly. This thing's big, right? And I would like to see PDD shake people out, come back in to this structure of, say, 103 and change, and hold this trend line. Then we can load some time and get up and out of here and shoot up. That'd be nice. So we'll see. We'll take an eye on it. I keep an eye on this. Tiger, it's a weird chart. It's just weird. All right, now let's take a look at Timing entries. This applies to anything. So okay, so this is your option chart. Okay. Now, a lot of people have asked, how do you chart an option chart? How do you chart levels? Well, this is how you're going to do it. You grab the hourly first, right? Whoa, 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 whoa. And you find the bottom, $2.34. Okay, then you take the hourly and you just do basic charting off key levels. So you can see there's support there, support here on this one, and support there. You may be thinking like, what? This is a fucking joke. No, no. This is very, very, very powerful. One of the most underrated things in the whole that not many people talk about. It's fucking gold. Because as you're trading, so here's my levels on my option chart, right? This is for this is the 60, 100. Now you go down to the 5 minute. Okay, after I did the hourly, I scroll down to the 5 and then I find out the key levels on the 5. There's that one. Resistance right there. And this is a big spot. So as I'm trading this, if I see volume, see the volume on the bottom of my chart? If I see large volume sticks on support, like say 1,000 or more, on a 5 minute, then I'm looking to buy this off support as long as my stock chart is telling me the same data that we have a reversal and or we're going to be going back up. Now, if you look at the put side, I also like to look at the put side because looking at the put side tells me if puts are being bought on a specific strike or if puts are being sold. This is the 1 hour. You can see how everything very nicely within structure. Why do you guys think this happens? Anybody know why the puts react this way in the option chain? Go to the 5 minute now. Come on, guys. Nobody wants to answer? Anybody know why the option chain reacts this way? You could say that's a level. No. Anyone else want to take a stab at it? All right. This is a hack. It's called a hack. It's 100% a hack. Okay. All right. Let me show you here. Okay. Let's first take a look at these hourlies. I think it's a hack. You don't have to, but I do. Okay. When you're looking at these hourlies, what do you notice? Let me see if I can draw. I'm not good with Weeble, as much on drawing because I don't drawing tool. Okay, all right, so here. Oh, perfect. I got it. I got it. Nice. Okay. Okay. what I notice is this. So the price is shooting up, right? And price, look at oops, shoot. Look at the range. Down, up, down, up, down. Let's go over this side. Down, up, down, up, down, up, down, up. Whoops. All right, my bad. So I'm sorry, I'm screwing this up here. Let me try to get this cleaner. I don't use the Weeble tool much to drawing. So let's go back. Down, up, down. There. All right, let me try this again. Drawing tool, red. There. What? Whatever. Down, up, down, up, down, up, down, up, down, up, down. So you're seeing the same shit here as you are over here. Literally the same stuff. It's identical. But what is the hack? When price shoots up in premiums, here's the key right here, guys. And premiums get inflated. Call premium here. Inflated. They don't just keep going like this. They always revert. Why? Why is that? Because if you're a hedge fund or a bank, right? If you're a bank and you buy calls down in here, right here, you see this volume right there? You bought calls. Okay, that's a huge buy volume, right? You bought calls there. You don't want to keep pushing the market like this. There's just no advantage to it. You want to create volatility. You want to create a Trump candle, right? Or whatever it may be, just selling pressure, right? So then you start unloading here. You start unloading your calls up there, and you maybe get some puts, right? Now let's look over here. At that time, what time was this? This is the 23rd. Yeah, look at this. And look at the same thing that happens here. At that time, you're down here. Now you start to buy some puts. Cheaper, up, reverts back up, and it extends out and gets really inflated on the put side. So now puts are overpriced, right? The point, what I'm getting at, is the puts and the calls both have a range. They cannot sit there and just go in a direction all the way down nonstop, right? And same with this one. They can't, they just, like puts cannot, or calls cannot keep going up and up and up because Wall Street wants volatility. The banks want volatility, right? And if you look at, let's go back to the big chart. And if you look at this, I mean, look at the 4 hour, just look at the 4 hour. This 4 hour, I mean, you know, let's just talk psychology, right? You know, this is a huge move down, huge move down. People are starting to chase puts. Oh my God, we're going to go down. Now, put premiums are so inflated. IV is jacked up here, right? Everybody's loaded short term, right? So when what happens to the big hedge funds? And the big boys, the banks that move the market, they know this. So they start buying cheap calls where the IV has been crushed, like low IV. Cheap calls, right? As everybody's still loading fucking puts, thinking death is coming, right? And then the call or the put premium is shot up, right? And the call premium's fucking dumped, right? And coincidentally, we're on support. So then the banks just buy calls, unload their puts, and then they rip the fucking market. There's a reason why Bank of America last year went, or the year before, went 100% on their trades. I didn't check the stats this year for last year, but the year before in 23, they went 100% because they moved the fucking market. They're the ones that I'm tracking on SPX, the banks, and the big boys that move the market. So then the same thing happens. It shoots up into resistance, calls, everybody's bullish, we're going to break out, yada, yada, yada. And now calls become increased and the IV's jacked up on calls, right? And then the same thing happens again. And it just keeps going on and on and on and on and on, right? And it's all it is the premiums on the option charts and the stock charts, they're lining up. And it lines up with psychology of people chasing the whole, chasing sentiment. But also, now what's kind of been happening, which is interesting, is everybody's like, oh, buy the dip. The dip always works. Because look what happened. You know, buy the dip, 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 buy the dip. Does this continue? Right? Because now people bought the dip here. Right? This is going to be interesting to me to see at what point does something just not stop dipping, right? At what point does this full schematic of what we're looking at on the higher time frames play out, right? And then really start to get aggressive to the downside, and that dip keeps fucking dipping, right? And everybody that's on margin, there's a lot of people on margin right now holding, they get shaken out, right? It could happen, it might not, but we'll see. But my point is the premium charts on option chains, they have a huge weight on directionality. When there's, and you know, anybody ever hear people say, "Oh my God, this is such a this stock or this option is underpriced." It's the same shit. It's the same shit. It's all the same. They're underpriced, and what happens is when they're underpriced, that's when you can catch good discounts and good values in a quick mean reversion. And it's the same thing intraday price action. When a stock fucking rinsing hard, yeah, you want to logically deductively reason like, okay, well, should I be buying puts here or calls? Okay, well, no, because really we're just stair stepping ourselves down. Or I could have bought calls here off of this big support off 50. Yep, catch a nice little move up, great. But it's weak. Let me get the fuck out. Right. End of the day, extension, yeah, good spot to buy calls. Right. End of the day, into resistance, good spot to risk reward puts, just to find your risk. So moving forward, really, we just want to understand the dynamics of how options move, where we can enter in, where we can buy. Like one of the guys in here, Volmageddon or Vince, he's amazing at charting, not just charting the premiums, but understanding how premiums move. Right? It's not new. There's a handful of people that chart and play off premium ranges, but you know what he's doing is he's looking at the schematic and the bigger picture of the broader market as well as the 15, the hourly, and the 4 hour, and matching it up with his risk levels on the schematic of Wyckoff, right? So he had laid this out, and let's see here. Let's go back to it. He laid this out, and look at that. It matches up perfect. So if you look at the premium charts, these puts right here on the second high probably double bottomed, right? This is probably a double bottom on the puts on the premium chart from here because you got theta and decay. The pop came up, and then if you loaded, you bet you see tons of volume on them. And then boom. So you have two layers of confluence that you can take it off of. You have the premium chart, you have the lower high, and then you actually have another one, which is the schematic, an M forming, right? And that's a great way to work into your system, for day traders and for swing traders too. So, oh, dude, what's up, Vince? I just saw it. You're on. You want to pop on and say anything? I'm half alive. It's all good. Let me think. The last thing I wanted to talk about would be so we covered EMA, strat, premiums, timing entries, swings. We talked about China and the dollar, and then we talked about the broader market outlook. Wyckoff basics and how it ties into some of my swing strategies. And let's talk about mentality here. Okay. So as we're trading, or when we go to bed, or whatever it may be, you're going to see, you want to kind of start thinking about your trades, right? What trade did I do good? What trade did I do bad? And why did I not succeed in it? Right? For most traders, most traders are outcome oriented. And when you're outcome oriented, you trade your P&L. You trade like, I need to have this money. And we have all done it. Like, nobody's perfect. Nobody's a robot. It happens, right? Having that juicy trade where you make 20K, that's what it's all about, right? It's like, oh my God, I want to get that day, right? Or maybe you have that day. It's fine. Maybe you're looking for 50K. But what kind of trader are you? Are you going to be focused on your P&L and focused on, the results in the moment, or are you focused on what's actually going to pay? Because if you take a trade, right, and you see this downtrend that you might have missed, and you're like, well, I know that 60.85 zone is a big spot, right? 60.83, 60.83 to 60.85, we'll call it, right? So there's the 60.85 zone, and you have your lower part of that zone would be, we'll call it 60.80, right? And you get puts up in here. Well, you're like, okay, well, I'm going to get puts up in here, and I'm going to risk close over 60.85, and they'll stop me out. And it doesn't, obviously, and it flushes down. Well, are you trying to, hold this whole size for, the holy grail? Well, you might hit it once in a while. That's great. But, thinking in the moment here, like that is dangerous, really fucking dangerous. And over time, you will blow your shit up. You might have one great trade, two great trades, but you will blow it up. My point is if you get into here in a put trade and it breaks and it flushes into an important level, sell 70% of your position. The premiums are so inflated, you have to, because you don't know for a fact that it's going to break this 60-50 level, right? And you just got a great trade, an amazing 300% trade here on that spot. So you sell that, and then you let a couple runners go. And then if you have another zone here, which there is, at 70, we just talked about this, you're not focused on your P&L. You're not you should not be focused on that at all. You should be thinking, in the moment, all right, I got puts. Where's my risk? Okay, in the moment, all right, my risk is a close over 85. Okay, they broke 80. That was my other zone. And then they broke 80. Now they're flushing. What's my target? Okay, 50. 50 to 53 is a good spot to sell. All right, I'm out 70%. Okay, now where's my stop? My stop's above 70. Okay, they can't break above 70. I'm still holding my runners. Okay, got an impulse move down under 50. They're probably going to wick it back up and retest it. All right, I'm out. Right? That's how you have to think in the moment when you're trading. Because if you're not, and you're like, oh, well, I'm going to hold, I'm going to hold. Yeah, sure. If you got 10 contracts and you sell 7 here and your stops don't get hit here, you sell another 2 here, leave one runner, right? And set it at break even, right? And then you get stopped out, whatever, right? No big deal. Made a hell of a trade, made, 400% on, 90% of your contracts. That's the way to trade, not, you know, you're in the trade here, perfect entry. You watch it go 300%, then you watch it go 70%, and you stop out because you freak out. Or you hold, and then it goes 350%, and you're holding, and then you're holding, and you're holding. Now you're fucking red. You know what I mean? Right? So like, don't do that. Like, it's about creating the good habits, process oriented, right? That they're like, these are the habits that pay you. Habits of staring at your P&L, habits of greed, those aren't going to pay you any money. But if you consistently focus on these kind of habits and the mentality that it takes to make money daily and consistently and define your risk, it doesn't matter what strategy you use, or, as long as it's not like too complicated and, like you're crunching numbers and math and all this shit. Like, it should be fairly simple. You look at this, you look at that, you got, some facts and real hard data that you're looking at that gives you the confluence that, hey, this is a good trade. We're pushing up into resistance, or hey, we broke a big pivot. I like puts here, right? I'll risk this level, right? So when you start to do that, trading becomes more relaxing. Trading becomes less stressful. Trading becomes more profitable. You become more consistent. But it's when you start holding for hope, you don't define your risk, you don't cut your trade, and then you beat yourself up, you talk shit on yourself, you talk down to yourself. Oh, well, that's just the way I trade, or oh, this is whatever it may be. That's going to really harm your ability to think clearly the next day. Okay. You need to be able to compartmentalize your thoughts in the moment and say, okay, where's my pivots? All right, my pivot's here. Okay, well, my pivot's here, my pivot's here. Okay, I'll take calls here, but I'll take puts off here. And what is the schematic or the direction that the overall room is seen in the moment? Okay. Are we looking bearish? Are we looking bullish? Are we looking for a new high to short, or whatever it may be, right? Or are we looking to long off this level? And that's where, Volmageddon, he posts his weekly or his charts, and, you can see the schematic. And then, I'll post my levels and my pivots in the morning write-up. And that's how you really want to go about it. It's when you start calculating how much money you're trying to make, as opposed to how much money am I willing to lose. There's a huge shift. Great traders, or sorry, I would say, unprofitable traders or inconsistent traders, when you start to become consistent and become profitable, the shift becomes, how much am I willing to lose, as opposed to, oh, how much can I make? Like, it's not about that. It's about how much am I willing to risk and lose. Yeah, that's a great point. Let's pull it up. Vince is bringing up a great point. Like, let's go here, I'll shift my screens. So this is the premium charts, right? And you can see, this is the hourly on both, right? So you can see here, I mean, if you get a move into this zone up here, and you're pushing up, I mean, how much really are you looking for? Are you looking for that big, you know what I mean? And you have zones here. This is the hourly I'm charting out. You have the low, right? So if you grab off this support down here at $9, right, and it shoots up into the next resistance. I mean, there's other levels in here. I'm just using this broadly. Shoots up to 28. I mean, that's a huge trade. That's, and so then you can sell. But if you're sitting there holding and holding and holding for this huge move, I mean, let's be realistic. You got a 50% retrace of the whole move. That's a hell of a move on premiums, right? So, let me see here. All right. Anybody have any questions? So let's take a look at the daily quick. So the 4-hour, to me right now, I just adjusted my trend line. You know what? Let me do this. Let me take another one just to do it, just to leave it there. Okay, so what are the options that we could potentially see here, right? So to me, this 15-minute is exhausted to the downside, right? It's on support. So could we see a reversion back up? Yeah, absolutely. Where would be a nice reversion to? Well, a retest of this trend line would be great to see. Retest or a retest of the 70 or the 88 block, right? In that zone would be a nice area to look to see, okay, maybe this is a great short opportunity. Okay, maybe this is a great long opportunity if they open us up flat on support and we're seeing nice structure to the upside, nice buy volume on the call side, right? And if you look at the hourly, to me, this looks like a UTAD, but it looks like it's just getting started. So you could see a bounce into supply at 54, 55, at the very maximum, maybe up into 70, and then to see this move come down into this bottom of the zone, maybe form an M, and then drill hard, maybe drill down into this area. Or the zone could drop down to here, bounce and drill. That's what I'm looking at. I have to see what Vince is seeing too, but that's kind of what I'm leaning at right now. NQ is at 21K over the weekend. Let's take a look at NQ. Yeah, it's at 21.5. It's a big spot. It never actually broke its trend like US 500 did. It did not. So NQ should have a huge reaction right off this trend line there. Let's see here. Yeah, we'll probably gap down. I mean, we're sitting in, yeah, so NQ probably, you think it's going to gap down that much? Oh, it says that. Okay. 21K. So where's that at? That's literally right on the trend line. That's crazy. Look at this. You guys, this is nuts. So here's the all-time high trend line tap, taps this wick, taps that wick, taps here, that candle closes a 4-hour chart. So we drill to the 1 hour. They broke underneath. They wicked it right off of it on the retest right there. Wicked it, candle close, wick support. And so 21K brings us right back to right there, right on the trend line. Yep. So that's the lower part of the demand zone. Now we'll see. We should see a big bounce off that. Hey there, Vince is posting some stuff here. Let's see what he's got. Yeah. Okay, so that's his trading range. Oh, excuse me. But all right, guys, anybody have any other questions? So if we're looking at this to drill down to 21K, that's going to set us up for DSAL, a big fucking M. Holy shit. Yeah. Yeah, huge fucking M. So we're going to look for a bounce to short. Yeah. If they gap us down that far, they're not going to just keep drilling it though. They're gonna they're gonna drive it up, and then we're gonna want to short that bounce. They probably drive it up into yeah. Well, we should get one more bounce off 21K. Yeah, 2005. Yeah, I have 450. Yeah, I could see that. See what you're looking at. This daily looks crazy. It's unbelievable. Twenty 20,538. There we go. Well, it's good. So it's a good thing that we're swinging all these puts too. But I think that's it for today. Oil. Let's take. Oh yeah, I want to. Last thing I'm going to do is I'm going to run through the sectors and then we're going to call it. All right. Let me go through the sectors quick. All right. So XLV, XLK. Oh, we get rid of this stuff. Oh, my sun's up. Yeah, this is weakening clearly. XLV. This is looking strong for a defensive play. XRT looks fine. XLE energy looks really weak. I'm sorry, guys. I got to hop off. My son just woke up. I hope you guys found some value in here today on the EDU session. Bitcoin is drilling. Ooh, wee. Just broke my range. Wow. My short term range. Take care. Have a good weekend. And don't forget, I'll put out the trade setups in the morning and what we're looking at. And then I will be posting alerts, but I won't be doing live Monday, Tuesday, or Wednesday. All right. Take care and have a great Sunday. Peace.